Hello and welcome to another quarterly update for the December quarter this time, and indeed for the calendar year as well, 2024. Joining me as usual is Dr. Steve Garth. Welcome, Steve.
Yeah, thank you, Jeff. It's always great to be here.
Our regular viewers, of course, know that Steve is a consultant to the Apw Partners Investment Committee and provides valuable input into our portfolio construction process. Steve, 2025, clock's ticked over. The US looks like they're playing their trump card this year, and should we maybe strap down for a bit of a bumpy ride?
You know, Jeff, with tariffs, trade wars, inflation, interest rates, geopolitics, I think it's going to be quite a ride this year in markets. And after saying that, this is just reinforces why we should all stay disciplined in the portfolio that we're in. And perhaps a good year to sit back, get the popcorn out, and just watch what happens.
Yeah, indeed. Well, risk mitigation, capital protection has probably been never more important. So I guess let's get back and have a look at how 2024 performed. Maybe we start with the Australian share market.
Let's start with the ASX 200, the broad Australian share market. You can see in the chart we've got up, Jeff. It's been a pretty good year, up in total 11.4% for the year, which, by the way, is above the long-term average, higher than the long-term average.
Healthy number.
So all in all, a very good year. You can see there's lots of wobbles along the way, so markets never go up in a straight line.
No.
But that's a good year. You do see the markets come off a little bit in the last few weeks of December, which has really brought down the last quarter result. It's a minus 0.8% for the quarter. And we actually do see that around the world. It did have to do with inflation expectations. I think they were just getting cautious as 2025 was about to start.
Yeah, it's a good point. We might touch a little bit later on the impact on bonds in the quarter as well in relation to that. Looking at the Aussie market, it sort of reminds me of that Dickens novel. It's almost a tale of two sectors.
That is right, Jeff. I think our viewers know that the two largest sectors in the Australian market are financials, the big banks, and the materials sector, which is the big miners. And you look at the chart here, and you're absolutely right. It is a tale of two cities.
Financials,
huge spread. I think it's probably the largest spread between financials and resources ever. So financials up 33% for the year. That's a great return if you're in the banks. But on the other hand, you're down around 14% for the year in the big miners. And most of that has happened in the last quarter. It's down by about 12% in the quarter.
Turning back to the banks, that's certainly the extraordinary outcome, but led in particular by one stock. And I know we don't normally talk at the stock level, but Commonwealth Bank has had a stratospheric run.
Really high PE. Many analysts are saying that it's due for a correction, but as always, Jeff, we're very careful about what analysts say. At the start of 2024, analysts had all sort of predictions about what would happen, and they invariably got everyone wrong. So it reinforces our view of having a diversified portfolio to make sure we capture stocks like CBA. If they're having a great run, fantastic. If they start coming off, there'll be other stocks there that will pick up that slack.
Indeed, diversification really, really critical. And so a great return in the Aussie market. But let's turn now to the global markets and see how it's compared there.
Yes, Jeff. Well, I think Ian, as viewers know, that the developed markets certainly are dominated by the US. That's about 70% of the developed markets. And once again, the US has had a phenomenal return. You can see in the chart here, US in Australian dollar terms up 37%. And it's really driven by those big tech stocks. In particular, a few years ago, we never would have heard of this company called NVIDIA.
No.
Now it's the largest company by value in the world. It's had an extraordinary run. And it's supported by other big names such as Apple and Microsoft.
Amongst its biggest customers, yeah.
Absolutely. So the tech stocks, again, have driven the US market, and the US market has driven the developed markets. But after saying that, Jeff, it's important to realise that other developed markets hit new highs as well. So over in Europe, Germany was hitting new highs, other markets hitting new highs. So when you look at the chart here, Australia at 11.6%, 6% return. But other markets have done even better than that in Aussie dollar terms, including the emerging markets have done really well in 2024.
Indeed.
So all in all, Jeff, the developed market index up 30% for the year. It's pretty rare that we get years where we get that kind of return in our portfolios.
Yeah, and I guess that's markets running so strong, that sort of sets the baseline for 2025 and beyond. And so it probably is prudent for us not to be anticipating a similar sort of number this year, but who knows?
Well, who knows? That's right. Again, let's just stay disciplined in the portfolios that we've got. Trying to bet against the US or to say, oh, I think markets are going to fall over. We just don't know. People were saying that at the start of 2024. Had one of the best years ever.
Yeah.
So stay disciplined.
The tech sector in the US in particular, I'm comforted by the knowledge our client portfolios have a significant allocation away from that. They've certainly benefited from that upside, but we also have a strong allocation to value and small company stocks. And so if things do turn south there, I think we've already got an element of protection in place.
Well, we have indeed. It's an element of protection. We tilt our portfolios to stocks with higher expected returns going forward. And the tech stocks, while they've had a terrific run, have got a lower expected return going forward. And in fact, Jeff, I think the audience will be aware that the Chinese just released a new AI thingamajiggy.
DeepSeek.
DeepSeek. And with that, NVIDIA fell 18% on a day. So these big US tech stocks are not invincible. And again, it goes back to the way our portfolios are positioned to capture the higher expected return stocks as we go forward.
Let's return to that theme we touched on earlier, the impact on bonds during the December quarter in particular. Reasonably volatile and quite subdued towards the end.
We are still seeing more volatility in the bond yields, and we've probably been used to over the last generation that you and I have been doing this, Jeff. And of course, a lot of this comes about because we had such low interest rates and they went up so quickly. And so the bond market, in a way, is still trying to find that level. And I'm sure, as everyone is aware here in Australia, but around the world, is the financial media is just dominated by what the interest rate movements are going to be, or what the central banks are going to do next. And what we've seen in the US is those yields have gone up in the last quarter, and in Australia too. That means bonds haven't had such a great quarter, and they're a bit flat for the year. But it is important to realise that now long-term yields are sitting around 4%. Bonds are now an important part of the portfolio because they're well positioned to protect the portfolio should the equity market does have an invariable downturn at some point.
Yeah, that's the primary role in the portfolio as a buffer to dampen the volatility of the share markets. But it's nice to know that you're starting to eke out a decent rate of return as well.
That's right, absolutely.
All right, Steve. Well, thank you once again for those insights into what happened through the 2024 year and the quarter just gone. And we look forward to seeing you next at the end of the March quarter. To our viewers, thank you once again for joining us. And we look forward to speaking with you again very, very soon.